Hello and welcome to Amberger Smackdown. I'm J. Christoph Amberger. If there's something remarkable about the subprime market shakeout since July, it's the way gold, oil and other speculative commodities have behaved. Because, by and large, they fell when stocks fell and they rose when stocks rose. Not exactly at the same rate, but close enough for government work. I've argued in the past that since the late 1990s, there was something like a commoditization of stocks taking place. Investing and trading in equities, especially in the respective options, futures and derivatives, appear to take place no longer based on the microeconomic analysis of a company's individual fundamentals and outlook, but as a mere speculation on fluctuating supply and demand for equity. Just as if your shares of AT&T and Sara Lee were as many pig bellies or barrels of oil. Today, exchange-traded funds own more physical gold than the central banks of some industrialized countries. Investment funds sit on more uranium than the Ayatollahs, and pension funds contain more crude oil than Wayne Newton's hair. Their interest in these commodities is based on the speculation that prices will go up due to the economic supercycle, the epic upswing in global demand caused by China consuming resources faster. Their buying is even more uncritical than Michael Moore gobbling up Cuban propaganda. They help along the upward trend in prices by idling supplies. But by betting the farm on Chinese industry, they have managed to align commodities with investors' expectations about the global economy. Make that the American economy. Or even better, make that their expectations about the continuing willingness to spend on the side of the American consumer. Because no matter what central bankers and economists have said about the supposed miraculous recoveries of the European and Japanese economies, it is still the American consumer, the much maligned Joe Sixpack, whose credit line generates the demand for goods and services that translates into double-digit growth rates for China and India, and the celebrated, although really quite anemic growth rates in Europe and Japan. But if China depends on Joe Sixpacks for growth, and investment funds and commodity investors depend on China for their upside, something curious takes place. Commodities, tied in knots by the recent dabbling of funds in their supply-demand equations, begin to follow the same impulses as stocks. After all, the outlook for both equities and commodities now depends entirely on the outlook for the American consumer. All this really has no practical consequence as long as two things remain the same. Our man Joseph retains access to cheap credit, and China gives no cause for a drop in demand. But let's say one of these factors ceases to exist. Banks call in credit cards. Or China experiences a serious political, financial, or economic setback, such as the fallout of its $1 trillion in bad debt. Either would result in a clear drop in demand for resources, because the Yanks don't buy, or the Chinese suffer an interruption in production by the evaporation of politically motivated credit. Suddenly, funds sit on huge inventories of resources. Demand drops, supply continues to build, and prices fall. Add into the equation that most fund investors these days have the attention span of SpongeBob SquarePants, the need for instant gratification of a toddler, and the economic horizon of a Democratic presidential candidate. They don't even think in fiscal years anymore, but in quarterly performance. Underperformance, caused by stagnating and falling commodities prices, turns those captains of finance into cabin boys with the intestinal fortitude of a cup of Jell-O. It matters not that a fund may have brought in 40% in gains last year. What matters is that it's down 20% this quarter. Capital is withdrawn. If the number of weak-kneed investors withdrawing principal swells, funds will have to sell. Sell commodities into a market already glutted with supply, which causes further prices to fall and investors to cash out. Oil, gold, cobalt, uranium could drop 5 to 10% for several days in a row, right alongside the world equity markets. All because Joe Sixpack in Poughkeepsie, New York, missed 2 payments on his suburban Colonial, and because his wife Jane decided to skip on the nail polish. I call it the equitization of commodities. It sounds like the exact opposite of my commoditization of equities, but hey, it's my party and I cry if I want to. You don't believe me? Well, look at the charts for the last 6 weeks. We just went through the dress rehearsal. For TaipanFinancialNews.com, I'm J. Christoph Amberger.